Hey guys, my name's Max. Thanks for tuning in tonight. I have a great video planned for you today. One of my subscribers was looking through the SEC's database and turned over a really interesting proposed prospectus. This hasn't been approved yet, but I would imagine that we'll see this ETF soon. Stick around and we'll get right in the middle of it. ULTY to get some new competition soon. Kurv has applied for a new high yield ETF that sounds to me a lot like ULTY, ULTY from YieldMax. Just from reading the prospectus, it sounds very similar. Kurv is one of the smaller companies I cover as far as assets under management goes. They only manage about 90 million between the ETFs they have, but they have some really good ETFs that do a nice job. In fact, oftentimes the Kurv ETFs outperform on NAV. They always outperform on NAV, but oftentimes they outperform on total return compared to the similar YieldMax fund. An example of that is KQQQ is a fund that is similar in concept to YMAX from YieldMax. KQQQ is outperforming YMAX on NAV return and on total return, but of course not on yield. That's what YieldMax is known for, yield. Regular viewers of my channel understand that high yields are great, but the yield is also a tax on NAV return. Therefore, it would follow that KQQQ has better NAV return, as its yield is less than half of what YieldMax does. Yield is about half. In any event, it's all about total return, right? And KQQQ has a total return of almost 18% for the past year. YMAX has good total return. It's 15%. That's not bad. At the same time, though, YMAX's NAV dropped about 5.5 points in the last year, while KQQQ's NAV was actually up about 10%. Don't sleep on KQQQ and don't sleep on Kurv. So the prospectus that one of my viewers found does not list a ticker, but if it's going to be a Kurv fund and it's going to be kind of similar to ULTY, I was thinking maybe KLTY or maybe KULT could be decent choices. Actually, on second thought, maybe not KULT. There's also no expense ratio listed yet. Investment objective. Okay, now I kind of summarized this from the prospectus. They do not say anything about upside. It's just purely for pure income. It doesn't even have a secondary objective of catching upside. It's a high income fund. So this ETF is actively managed and invest in U.S. and non-U.S. securities, stocks and ETFs, and derivatives like options. Get this. This is the part that sounds like ULTY, or this is one of the parts that sounds like ULTY. The investment advisor selects these based on favorable outlooks, looking at factors like growth or momentum of the issuer and the implied volatility of the derivative instruments. High implied volatility suggests potential for significant price swings and higher option premiums, which helps the fund generate income. The fund primarily invests in the listed securities or options on them. It can gain exposure directly by holding the security or indirectly through synthetic exposure. Synthetic exposure is achieved by buying a call and selling a put at the same time. It kind of sounds like ULTY's business model to me, which is good. I love ULTY, and I think it's one of the best YieldMax ETFs out there. I like YMAX also, but YMAX didn't hold up so well against KQQQ. Yes, I know YieldMax and Kurv both have some good single stock funds as well, but I prefer indexes and high yield ETFs that have multiple companies like KQQQ and YMAX. The next section of the prospectus deals with how the ETF uses option strategies, specifically covered call writing and uncovered call, naked calls, and or naked puts. Naked puts are cool. I'm not sure about naked calls. But they also do call and put spreads. They also do risk reversals, which of course I love. They also do protective puts and call purchases, otherwise known as callers. All right, so covered call writing. The fund sells options on the security it owns, either directly or synthetically. This generates income from the premium received from the sold option, but it limits the fund's potential upside. And notice they did not say anything about upside in the first sentence of the fund. They just said it's purely about income. So they're telling you right here that the covered call reduces the chance of upside. All right, but they also do this. They also do uncovered call and or put writing. So uncovered calls, call it naked calls. The fund sells call options on securities it doesn't own. This is done to generate income without tying up capital. However, it's riskier than covered calls because loss potentials are potentially unlimited. If the underlying securities price rises sharply, the fund must maintain margin as collateral. I'm not so sure about that, about what I think about that. But anyway, uncovered puts are cool. An uncovered put is the same thing as a covered call, but you don't even need stock. You don't have to buy stock. Just sell a naked put, and you're essentially in the same position as a guy that owns stock and sold a call. So the fund does sell put options on securities it doesn't have a short position in or hasn't collateralized. The goal is to earn premium income and potentially buy the underlying security at a lower price. If the option is exercised, the fund is obligated to buy the security if the price falls below the strike price. You guys all know how those work. Naked puts are some of the best plays out there. Other strategies, call and put spreads. The fund sells one option and buys another similar option with a different strike price, aiming for increased participation in the price appreciation while still generating some income. And they also do risk reversals and protective callers. The fund sells an out-of-the-money call option and simultaneously buys a put option to limit losses from the underlying security with the call premium offsetting the put's cost. That's called a protective caller. Protective put, the fund also buys out-of-the-money put options to limit potential losses. That's always a good play. And then call purchases. The fund can also just buy calls to gain for price appreciation. So they have the whole playbook. That's pretty much the whole playbook. In all option writing strategies, the fund must post collateral, cash, or high-quality short-term instruments to secure the obligations to the option buyer. So this sounds to me like basically the YieldMax ULTY playbook. So let's dig a little deeper. The next section goes into more detail with what they're going to do. So the fund aims for exposure to the underlying securities in two main ways, either synthetically, that's a bought call and a sold put at the same strike. They could do a combo, which is a bought call and a sold put at different strikes. But basically, that's just an option trick to get you exposure to the underlying. And then they can sell covered options, or the options are now covered with the synthetic. If they sell a call and they own a synthetic, it's not a naked call. It's covered from the synthetic. And then the fund also may directly purchase the underlying securities, although it sounds to me from reading the prospectus that they're going to do the synthetics. But we don't know yet, and we don't even know for sure if this will be approved or if there may not be changes between now and the time it gets approved. But I'm going to keep on top of this. I'm really excited about this one. All right, let's talk about the generating monthly income. So the core strategy for generating the income comes from selling call options on its underlying security. So I was wrong. They're going to try to do it on the stocks itself. The call options usually have a short-term expiration, 1 month to 1 year, with the strike price 5 to 15% above the current share price or out of the money. By selling these calls, the fund receives an upfront premium income. However, the strategy caps the fund's potential gains in the underlying securities if the underlying securities price rises significantly above the option strike price. The fund gives up that upside potential in return for the premium, and then they use the premium to pay the yield with. If the securities price stays below the strike price, the option expires worthless and the fund keeps the premium, and that's kind of the best scenario. Or I guess the best scenario is for the securities price to expire right at the strike price. That's the max. That's the max potential. If the price goes above the strike price, the fund will either close out, meaning repurchase the option to avoid being exercised, or they'll roll the option out. And we see Jay do this all the time. And well, all the funds do it, but in ULTY, they're doing it all the time. They'll keep rolling the options out to stocks that are appreciating. So even though the covered call is capped, they roll aggressively to mimic the return of a stock. The extent to which the fund participates in any stock price increase is limited by the strike price of the sold call options. potentially leading to underperformance compared to simply owning the stock directly. And we know how that goes. I harp on that all the time. That's why I don't like, typically, I don't think these are great investments for younger people. But that's just my opinion. But be that as it may. All right, then it's going to say right here, collateral and option types. Then it says here, the fund heavily invests in short-term treasury securities to serve as collateral for its synthetic covered call strategy. I guess when I saw that line, I thought that it was going to be they were going to use T-bills and synthetics. The treasury securities contribute to the fund's monthly income goal also, because those treasuries pay what, 4, 5, 6%, whatever. It depends on how far out they go, but they pay a little bit. Then it's going to also say the fund uses exchange traded option contracts, including flex options. So flex options are kind of option nerd stuff, but they're options the public can't buy. If you're ever looking at a fund's positions and you see a funny strike price, like the strike price is like 201 and like 3 cents, that's a flex option. And all a flex option is off market, usually the counterparty's a bank, and they have different rules with flex options, and funds like to use these to avoid an early assignment. Because the flex options can be European style, meaning they can only be exercised on the expiration date, but not prior to that. That gives the fund a lot more reliability with being able to predict the income and the outcome. It also makes the option strategy less path dependent. It helps kind of negate some of the path dependency. What do you guys think? I mean, the use cases for this ETF to me are somebody that likes ULTY, but doesn't want all of the ULTY risk, especially the NAV risk. Now, this doesn't mean ULTY is a bad fund. ULTY has very good total return. ULTY for the past quarter has positive NAV return also. But of course, the market's been ripping. So, this I think might compare favorably to ULTY. It'll probably make a whole heck of a lot less yield because it sounds like they're using monthly options. ULTY does the weeklies. That usually cuts the yield in about half. It's been my experience. So what's ULTY paying? Around 80%. Let's say this one pays 40%. But what's the other side of that? It's going to get more, it's going to have more potential to get NAV upside. Now, it still needs the market to go up. It's not just about, the options. You still need the market to go up, but in other things being equal, in a market that goes up, I would expect this fund to pay about half the yield, but to get more NAV upside. And as far as total return goes, that's anyone's guess. And that's anyone's guess, but lots of times the fund that is leading in NAV upside is also leading in total return, but not always. I was thinking about calling it ULTY for chickens, but anyway, some people do want option income, but they don't want to see the NAV fluctuate so wildly. And this might, this could be the ticket. All right, guys, I hope you like this. Let me know what you think in the comments. All right, have a great night. See ya.